Welcome back to Risk to Reward. Today we are breaking down Lloyds Banking Group. Starting with the share price, what you are seeing on screen is Lloyds Banking Group share price from early 2020 through to January 2026. In March 2020, the share price fell sharply as COVID triggered a global market crash. Banks faced severe uncertainty, expected loan losses increased, earnings visibility collapsed, and UK regulators required banks, including Lloyds, to suspend dividends in order to preserve capital. As we move into 2021 and 2022, the recovery phase begins. Economic reopening and rising interest rates materially improve the outlook for UK banks. For Lloyds, higher interest rates increase net interest margins, meaning the bank earned more on lending relative to what it paid on deposits. Through 2022 and 2023, Lloyds focused on restoring profitability, reducing costs, and strengthening its balance sheet. By 2024 and into January 2026, the share price shows a steadier trend with reduced volatility, reflecting improved capital strength, more predictable earnings, and the resumption of shareholder returns. Turning to the latest reported full-year results, Lloyds continues to operate as one of the UK's largest retail and commercial banks, with earnings primarily driven by interest income from mortgages and lending. The results show a business focused on consistency rather than aggressive growth. Income remains supported by the interest rate environment, while disciplined cost control has helped protect profitability. On profitability, Lloyds continues to generate solid returns for a mature, highly regulated bank without relying on excessive risk-taking. On the balance sheet, Lloyds reports a strong capital position, with capital ratios comfortably above regulatory requirements, providing resilience against economic uncertainty. This balance sheet strength allows Lloyds to continue lending to households and businesses while also returning capital to shareholders. Dividends and share buybacks remain a key part of the investment case, but are framed around sustainability and capital discipline rather than short-term maximization. Overall, the latest full-year results reinforce Lloyds' positioning as a stable, income-focused UK bank with strong capital foundations. Beyond traditional banking, Lloyds has also been expanding into real assets through its build-to-rent strategy. Today, Lloyds' build-to-rent platform includes approximately 7,500 to 7,600 homes across the UK, with a disclosed portfolio value of around £2 billion, based on company disclosures and public reporting. This strategy is designed to respond to long-term rental demand in the UK, where housing supply has consistently failed to keep pace with population growth. For Lloyds, build-to-rent provides diversification beyond core banking, alongside long-dated and often inflation-linked rental cash flows. Looking ahead, Lloyds has stated an ambition to significantly scale this platform, targeting around 50,000 homes by 2030. This is a strategic objective rather than a guaranteed outcome, and remains dependent on planning approvals, market conditions, and capital allocation decisions. However, it clearly signals Lloyds' intent to combine traditional banking with real asset investment as part of a long-term, defensive growth strategy. Taken together, Lloyds' journey shows a clear progression, recovery after COVID, disciplined profitability, strong capital management, and strategic expansion into real assets. If you value clear, data-driven analysis like this, follow Risk to Reward for more institutional quality investing breakdowns.